to all our clients tuned in this morning. I noticed that we have many new visitors on this webinar and some accountants too. So a special and warm welcome to you, and thank you for joining us. My name is Monique Charland. I'm a professional accountant and a specialist in business advisory and tax law for the SME sector, and I'm also a franchise expert and founder and CEO of the national franchisor company, Business Accounting Network, or better known as BAN. Whether a business requires an audit or an independent review or a compilation of their annual financial statements, this is all determined by law. And we are going to unpack the significant differences between these three engagement types. I'm going to hand you over. First of all, I'd like to welcome our host today, Shane Webb. Thank you very much for hosting this seminar or webinar. And I'd like to introduce you as well to our presenter, Madeleine Pretorius. Now, Madeleine is a BAN franchise owner based in Paarl in the Western Cape, and together with myself heads up technical training within the BAN franchise group. Madeleine is a qualified chartered accountant. She qualified in 2012 after completing her cycle articles at PricewaterhouseCoopers in Gauteng, and is a registered CA with the South African Institute of Chartered Accountants. But just a little bit of housekeeping before we get started. We would love to hear from you. So if you have any questions during the presentation, please type them into the question box in your control panel on the right side of the screen. You may address questions at any time during the presentation, which I will address together with Madeleine at the end of this webinar. And to obtain a copy of today's slides, please visit BAN's website on www.ban.co.za under the events page. So without any further ado, I'd like to hand you over to Madeleine. Good morning, Madeleine.
Morning, Monique. Thank you for your lovely welcome as usual. Thank you to everyone joining our webinar today. Good morning, and yeah, I hope it's not as chilly as here in Cape Town where you are. Let's have a look at the differences between an audit, an independent review, and a compilation. As a business owner, you may be uncertain when it comes to your annual reporting, which of these engagements is best for the sign-off of your financial statements, and how your accountant can assist you with this. But today we'll be unpacking these differences between the most common audit services to give you a much better understanding. I'd like to start off by re-looking or refreshing the financial reporting frameworks. Now, for those who might have joined us at last month's webinar, the next couple of slides might jog your memory, because the financial reporting framework and which one you choose is quite fundamental, because it directly affects or is related to the engagements on your financial statements. So what is a financial reporting framework? It is a set of guidelines used in the preparation of financial statements. It is mainly principle-based, so it relies on the integrity and competence of management to make significant judgments. And it's typically based on the type of business that you have, the objective of the financial statements. In other words, what are you going to use them for? Who will be looking at them? And also applicable laws and regulations to your specific business. But why do we need a financial reporting framework? Well, to provide useful information to users of the financial statements. And this information that you present in your financial statements should be useful from a number of perspectives. So whether it is a creditor who is providing credit to a customer, or whether you need to lend to a or invest in a business, the financial statements need to cover all those perspectives. A financial reporting framework also assists in providing information about the cash flows to which the entity is subjected, including the timing and uncertainty of these cash flows. And this cash flow information is critical to determine the liquidity of the business. In other words, will this business be able to pay their debts as they become due in the future? It's also important to disclose the obligations as well as economic resources of an entity, including emphasis being put on the changes of those obligations and economic resources throughout the year or the period that's being reported on, as well as in the past. So in other words, if we look at a trend in the financial statements, because this is used to predict future cash flows of that business, which the users of the financial statements then can use to make decisions. A financial reporting framework also allows comparability of financial statements, and that becomes quite important. For example, if you take your financial statements to a bank for financing and they need to say, for example, give your business a credit score, they can use your financial statements prepared on a financial reporting framework and compare it against other companies that are similar. And it also improves the efficiency of business across borders, especially if you use a financial reporting framework that is internationally recognized. For example, IFRS for SMEs. The two most common financial reporting frameworks that you'll see in small and medium-sized entities is the tax base of accounting and IFRS for SMEs, which is the International Financial Reporting Standards for small and medium-sized entities. Now, what is the difference between these two? The tax base is based on historical cost. So the profit or loss that you calculate for accounting purposes would more or less equal to your taxable profit and loss. The only differences will be what we call permanent differences. And to give you an example of that would be, for example, if you make a donation, but you don't get a tax certificate for that donation. For accounting purposes, you will deduct that as an expense. But for tax purposes, because you don't have the Section 18 Cap A certificate, you have to add that back, and that will then be a permanent difference, a difference between your accounting and your taxable profit and loss. Or another one would be, for example, dividend income. Dividend income would form part of your income for accounting purposes, but for tax purposes, this is usually exempt, so it will be excluded from your taxable income. On the other hand, IFRS for SMEs is based on principles of fair value. So your profit or loss from an accounting point of view will definitely not equal to your taxable profit and loss, because there are various adjustments that need to be made for accounting purposes that will not affect tax. So what is fair value? If I just give you a definition in terms of from an accounting point of view, fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. So you can see that the fair value is a rational, unbiased estimate of a potential market price of a good, service, or asset. So what IFRS for SMEs is trying to do in terms of its principles is to bring your financial statements to a more almost current value, and rather than just keeping everything on historical cost, so that anyone looking at your financial statements gets a much truer or more accurate view of where your business stands now in terms of value as well as obligations, and how that can change maybe in future. The tricky part is to determine the fair value of items or line items in your financial statements that are not necessarily traded on an active market. So IFRS for SMEs does provide you some leniency because they understand that there is a cost related to trying to determine fair values that small, medium-sized entities might not really benefit from. What IFRS for SMEs also requires is accountability and responsibility from management, because management suddenly has to step in and make significant judgments with regards to accounting policy choices, estimates. So directors need to apply themselves, their knowledge and their due care to make sure that these are correctly applied. When I talk about accounting policies, the accounting policies are basically, I'm going to say almost choices. It depends really on what section of the financial statements you're looking at. I don't want to go into too much technical detail, but the accounting policies are used to shape the financial statements and the accounting records. And to maybe give you an example for you to understand, let's look at property, plant, and equipment. Let's say you have an asset. IFRS for SMEs gives you an accounting policy choice, whether to carry that asset at cost, less accumulated depreciation and impairment, or to carry that asset at revalued amount, which is closer to fair value. So by making that accounting policy choice, depending on the asset and the nature of the business and how you're using that asset, and how easy it is in terms of cost and effort to determine that revalued or fair value amount of that asset, directors or management would then make that accounting policy choice, and you can immediately see that in your financial statements, it will have a huge difference. You could either have depreciation being shown, if it's costless depreciation, or you could have a revaluation amount being showed if you carry it on revalued amount. So you can immediately see that your accounting policy choices do shape your financial statements. And therefore, it's very important to consider these and apply your judgment very carefully. Let's have a look at a few examples to illustrate the differences between these two financial reporting frameworks. Property, plant, and equipment. Under IFRS for SMEs, you would determine depreciation based on an accounting policy choice and an accounting estimate. So you would, for example, go and estimate what would the residual value of this asset be at the end of its useful life, and what is an estimate of its useful life. In other words, how many years can I use this asset and derive benefit from it before it can no longer be used? Whereas from a tax-based point of view, you would most probably use the wear and tear schedules that are actually legislated by SARS, and that wouldn't necessarily be the same as your accounting estimates or useful life under IFRS for SMEs. Investment property are properties held for capital appreciation or for rental income. Under IFRS for SMEs, these are required to be carried at fair value, with any change, gain or loss being put through to your profit and loss or income statement. Whereas from a tax point of view or tax base of accounting, you wouldn't get any capital allowances on investment property, and it would only really hit your tax calculation right at the end if you possibly sell that asset, where it would most probably lead to capital gains tax, because an investment property or property is most likely to increase or appreciate in value over time. Mortgage bond. Under IFRS for SMEs, these will be carried at amortized cost, which goes and looks at calculating the interest and capital payments that you need to make, the interest accruals over time, and how that actually almost works out to a zero value at the end of the maturity of that bond. Whereas from a tax-based point of view, the mortgage bond would most likely be carried only at historical cost. Rental payments. IFRS for SMEs requires that if you have rental payments that escalate from year to year, so let's say you have an office building and you pay rent on that, every year it escalates at say 10%, which is much higher than inflation, then you need to straight line or almost average those payments over the period of the lease or the rental and recognize that in your profit and loss. Whereas from a tax-based point of view, you would recognize the expense on the earlier accrual or payment straight away and not have to straight line anything. And something like salary bonuses, if you have a contractual obligation in terms of employment contracts to pay salary bonuses, for IFRS for SMEs, you can create or recognize a provision. In other words, you bring in the expense in the year in which that bonus accrues, and you raise a provision, whereas you might only pay it physically the following year. Whereas from a tax point of view, you would only recognize it as an expense when it has actually been paid. And one very large or almost crucial difference between your IFRS for SMEs and tax base is when you actually look at your actual tax line item. Under the tax base, you would calculate your normal current tax as always, whereas under IFRS for SMEs, you not only have your current tax, but also deferred tax. Now, what deferred tax tries to do, almost in a nutshell, is to show the future tax effects of the items on your balance sheet, or statement of financial position, your assets and liabilities, so that it more accurately reflects the company's financial position and the tax effects going forward. And that is one of the crucial differences that you'll see. If you ever see deferred tax in financial statements, you know they're most likely prepared on IFRS or IFRS for SMEs. Let's move on to the actual differences. So now you understand what a financial reporting framework is, and as we go through the different financial statement engagements, you'll see why that is so important to pick the right the right financial reporting framework. Now I'd like to draw your attention to this diagram and the almost increasing or progressive nature of it. So you can see on the one end of the scale we've got a compilation, which goes or increases almost into an independent review, and on the other end or the top end of the scale we've got an audit. Now, what I'm trying to illustrate here really is the progressive nature of these engagements. They are all different types of engagements and they're all separate from each other, but they do actually increase in terms of the amount of work that goes into it, the time spent, the cost related to it. So on the one end, the compilation would be your the least amount of time spent, going more into your independent review, and then obviously an audit is very detailed. So there's more hours involved in performing an audit. And then obviously there would be a related cost to that. So your audit would be much more expensive than an independent review, which is obviously more expensive than a compilation. But taking into account also what you are getting out of it and what the objectives of these different engagements are, which we are going to look at in the webinar today. Now, you might be making use as a business owner of an audit firm to perform your financial statement engagements, but just be careful, because an audit firm is signing off your financial statements. It's not to say that they've performed an audit on your financial statements. So it's very important that you go and check in your financial statements. In the first couple of pages, you'll see that there's a report. And that report would either state that it's a report of an independent reviewer, or an audit report, or a report of a compiler. And that will give you an indication of what type of engagement has been applied to your financial statements. And even going back to before the engagement started, you would most probably have signed a terms of engagement with your service provider, and that will give you an indication of what is actually being signed off on your financial statements. And what's important to understand is the difference between these engagements in terms of what they're actually telling the users of your financial statements, and that we'll be looking at in the next couple of slides as well. Something to remember is, even though I'm going to show you some specific or practical considerations in terms of each of these engagements, they all also encompass almost blanket or umbrella considerations, such as ethics, quality control, things like independence, integrity and competence, technical standards. So whoever is performing this engagement for you needs to comply in all three of them with those blanket or umbrella considerations. So it kind of gives you a little bit of comfort as well that there are certain ethical requirements that also need to be adhered to. So let's go and look at some of the detail. We'll start off on the bottom end of the scale with a compilation. Now, a compilation is an engagement to assist management with the preparation and presentation of historical financial information of an entity in accordance with an applicable financial reporting framework. So I've just highlighted a few keywords here. And you'll see the keywords that I want to show you is preparation and presentation. So it's bringing all the information of your accounts into financial statements. And another keyword here is historical. So a compilation is mainly targeted at your financial statements for the year that has already passed. And it must also be in accordance with an applicable financial reporting framework. In most cases for small, medium-sized businesses, this would be IFRS for SMEs. Now, a compilation provides no assurance on the financial statements. So there is no opinion that is being presented by the practitioner. However, there is a certain degree of implied assurance about the fair presentation and relevance of the financial statements, because by complying with the financial reporting framework, with the accounting standards, you are already ensuring a certain degree of fair presentation. And because the practitioner who compiles your financial statements also needs to prescribe to the procedures in terms of IFRS 4410, which is your International Standards of Related Services, those procedures would also give you some implied assurance on the financial statements. Now, when we look at a compilation being a preparation and presentation of financial information, we need to just look at the difference between preparation and compilation as such. Because when we talk about a company, a lot of the times we refer to the compilation of financials. But when we talk about a closed corporation or sole proprietor, we very often refer to the preparation of financial statements. So what is really the difference? The main difference between a preparation and compilation is that a compilation requires independence of the professional who is compiling your financial statements. That professional must comply to accounting standards, and this in turn increases the trust and reliance of the users on your financial statements. Now, what are the requirements of a compilation? As I mentioned, independence and integrity of the compiler is very important. That compiler must exercise accounting and financial reporting expertise and comply to the relevant financial reporting framework or the accounting standards, which in most cases will be IFRS for SMEs. The compiler will then also prepare documentary evidence to support the compilation procedures in terms of IFRS 4410, because as I don't know if you might have heard the term, if it's not documented, it's not done. So we need written evidence of the procedures that have been performed. And in a compilation, the compiler also needs to consider materiality. Now, what is materiality? It is a concept whereby if anything in these financial statements is wrong, or misleading, or is not correct, or could be false, it will only be material. In other words, it will make a difference to the users or the decision making of the users. So it's either that large in terms of monetary value, it's so huge that it will completely change a decision that a user might have made if it was incorrect, or by nature it could be material. In other words, it could be fraud, it could be theft. So from a compiler's point of view, he still needs to consider materiality, because if the compiler or the practitioner finds anything in terms of this engagement, any information to be materially misstated or misleading, then that compiler must recommend changes or amendments to management. So in a compilation, you are not necessarily looking for misstatements, but if you do notice something, then you need to actually correct it, recommend to management to correct it. And if management doesn't want to, then that is a very clear indication that you need to withdraw from the engagement. So materiality, you'll see through all of these financial statement engagements, is quite an important concept. Moving on to an independent review, which is a step up in the scale. This is an engagement to perform a review of the historical financial statements of an entity and to express a conclusion on whether the financial statements as a whole are free from material misstatement. So you can see where a compilation was the preparation of the financial statements, an independent review is a step on where you are reviewing the actual financial statements. So they've already been prepared, you are now performing work on those financial statements. And once again, you can see the word material. So materiality also comes into play. Now, an independent review provides limited or negative assurance on the financial statements. And I've just included an excerpt here from an independent reviewer's report, which you will see in your financial statements, just to illustrate what negative assurance is. And you'll see the report states, nothing has come to my attention that causes me to believe that these financial statements do not present fairly in all material respects the financial position of the company, the cash flows, the financial performance, in accordance with international financial reporting standards for small and medium-sized entities, as well as the requirements of the Companies Act. So just by looking at that one paragraph, which is the conclusion that an independent reviewer might have come to if he or she reviewed your financial statements, limited or negative assurance means nothing, the procedures have been performed, but nothing has come up. And you'll see when we look at an audit in the next couple of slides, the difference between negative and positive assurance. You can immediately also see from that paragraph in an independent review, we once again look at materiality. So how large or how important are any potential misstatements? And there has to be compliance with your financial reporting framework, as well as legislation, the Companies Act of South Africa. So what are the requirements of an independent review? Here, a lot of emphasis is being placed on independence and integrity of the reviewer. So a review engagement cannot be performed by a practitioner who is involved in the preparation of the financial statements. You can only really form an unbiased opinion on something if you are removed from the subject matter. The independent reviewer must comply to accounting standards or the financial reporting framework. And in this case, an independent review involves the assessment of financial statement risk, which is very different to a compilation where no mention of risk is made. The independent reviewer needs to apply professional judgment or skepticism and perform procedures in terms of the independent review, which is mainly inquiry and analytical procedures. And once again, documentary evidence needs to be prepared to support any of the procedures performed. You'll see when we look at an audit, some of the main differences between a review and an audit is that the review doesn't involve any tests of balances, which is core or key to an audit. And it also doesn't involve an examination of the client's system of controls or for the existence of fraud, whereas with an audit, the procedures are designed to detect fraud. Let's have a look at that. An audit is an engagement to perform an examination of the entity's accounting records, to express a conclusion about whether the financial statements are presented fairly in all material respects. So just by looking at the keyword examination that I've highlighted in bold there, you can immediately see that an audit is much more detailed than a review, because a review implies high-level overview, whereas examination goes into depth, it goes into the detail of the accounting records. So you can see the natural progression from the different types of engagements. Now, an audit provides reasonable or positive assurance on the financial statements. So just looking at an excerpt from an audit opinion, an unqualified audit opinion paragraph, the financial statements present fairly in all material respects. So if you just go back to the slide previously where we looked at negative assurance, nothing has come to our attention. Whereas an audit goes and looks at the financial statements present fairly, you can immediately feel the difference. Whereas an independent review goes and says, I didn't notice anything wrong. An audit goes and says, the financial statements present fairly. It's positive. And that shows you the difference in the strength between the assurance that you get from an independent review and an audit. And once again, an audit also looks at materiality. So all material aspects are presented fairly. And it also goes and looks at the International Financial Reporting Standards for small and medium entities. So compliance with your financial reporting framework, as well as the Companies Act compliance with legislation. Now, an audit gives you the highest form of assurance. But just remember that you can never get absolute assurance due to the very nature of an audit in terms of testing of samples and the procedures being designed. What are the requirements of an audit? An audit must be performed by a registered auditor and comply with certain standards that are put onto that auditor. There has to be a performance of procedures on the amounts disclosed in the financial statements. So it usually involves a testing of sample of transactions or balances, getting third-party confirmations. So the auditor must corroborate the ending balances in the client's accounts, as well as the disclosures in the financial statements. So source documents would be examined. Third-party confirmations, as I mentioned, would be received. Physical inspections, and also here, which you won't see in a compilation or an independent review, controls are being tested. The procedures are designed to identify material misstatements, and the auditor also needs to comply with the accounting standards or financial reporting framework, as I mentioned. And once again, if it's not documented, it's not done. There has to be detailed documentary evidence prepared to support the audit procedures performed and the results or the conclusion of that audit. Now you may, then I've prepared a summary for you, a very nice table, which I find quite helpful in terms of the key points of each engagement, and then looking at them side by side and comparing them that way. And I think that is quite a nice resource to refer back to if you are unsure as to the difference between the various engagements. So first of all, I'd like to look at the objective of the engagements. A compilation's objective is to assist management in the presentation of financial information in the form of financial statements. An independent review's objective is to obtain limited assurance that there are no material modifications that need to be made to those financial statements. Whereas an audit, its objective is to obtain a reasonable level of assurance about whether the financial statements as a whole are free of material misstatement, and that enables the audit to express an opinion on whether the financial statements are presented fairly in all material respects. So you can see the different objectives, and that already gives you an indication as to when you would use these engagements and what you want to actually, what is the goal of using them in the financial statement. So what do you actually want to get out of that report? The level of assurance, you can see compilation has no assurance, an independent review moderate or negative assurance, and the audit reasonable or positive assurance. Now, what are the common applications of each of these engagements? A compilation is generally appropriate for privately held companies, and it's quite often used for simple situations. For example, a lender needs IFRS for SME financial statements instead of the statements prepared by the internal accounting system, or that lender needs additional comfort by knowing that the accountant or an accountant or professional independent accountant read the financial statements and prepared the financial statements. An independent review is also often prepared for privately held companies, specifically because third parties seek additional comfort that the financial statements are not materially misstated. So it could be a bank, a creditor, a potential purchaser. They need an independent review so that they have additional level of confidence and comfort in the financial statements. So your independent review report becomes very important, and it's significant to both the business owner and the company because it helps you to further the operations of your business. For example, if you seek financing, the bank will much rather rely on your financial statements if it's subject to an independent review than possibly merely a compilation. An audit is often prepared for companies, again, due to third parties requiring an auditor's opinion on the financial statements. And there could be certain cases where an audit is mandatory, and we'll look at those in a couple of slides on. Reliance on management. A compilation almost entirely relies on information presented by management and then uses that information to present and prepare the financial statements. However, even if you're only doing a compilation and are placing some type or some level of reliance on management information, the practitioner still needs to consider professional judgment, use their professional judgment and skepticism, and make sure that the information that they've received from management is reasonable and it makes sense. An independent review, however, requires some testing of the information provided by management, and that is why an independent review can actually give an opinion or a conclusion or that limited assurance, because there's testing performed on management information, and this testing usually takes the form of analytical procedures and inquiry. And then going on to an audit, you'll see an audit gives significant corroboration of account balances and information provided by management. So there's more detailed testing involved, and that is why your level of assurance is much higher. Understanding of internal controls. The compilation doesn't require any understanding of the internal control system of the company or the business. Whereas an independent review, you need to obtain an understanding through inquiry, because that will help you to identify risk areas in the business. An audit, however, you do use the system of internal control and perform tests thereon, because that will actually determine what further testing you will then do on the financial statement line items to be able to conclude and form an opinion in the audit. You might be asking, okay, so we've looked at a bit of theory in terms of the different types of engagements, but when do I use them? When is it appropriate to merely have a compilation or an independent review? When do I need an audit? And I think a good thing is always to go to your accountant and ask their recommendation and guidance, because they will have the technical knowledge to guide you. But just to give you an understanding, the choice as to which engagement to use is very much driven by the requirements of legislation. So the Companies Act of 2008 and the accompanying companies regulations. And in the new Companies Act of 2008, you'll see something called the public interest score. Now, this is a calculation or a mechanism introduced by the Companies Act 2008 that determines the type of engagement that must be performed on your financial statements, whether it is an audit or an independent review, the accounting framework that must be adopted, so IFRS or IFRS for SMEs, and certain other corporate governance issues that must be complied with. So how do you calculate your public interest score? Well, there are various elements. First of all, you'll get a number of points that equal the average number of employees during the financial year. So you'll take your average number of employees and allocate a point to each one of these. Then you will also allocate 1 point for every 1 million rand or portion thereof in third-party liabilities at the financial year end. And you'll also allocate 1 point for every 1 million rand or portion thereof in turnover or revenue at the end of the year or during the year, and 1 point for every individual who at the end of the financial year is known to directly or indirectly hold a beneficial interest in that company at the end of the year. And that will calculate your public interest score. Now you may ask, okay, but what does that really mean? And the public interest score is then used in terms of an application as to which engagement you use. And I'm going to show you that in a very nice diagram, or shall I say a decision tree. Just quickly going to go to that. Now this decision matrix or decision tree on whether your company is required to do an audit or a review is straight from the SAICA guide on Companies Act. Now, SAICA is the South African Institute of Chartered Accountants, and you'll see that this decision tree or diagram that I'm going to go through with you basically encompasses all the regulations of the Companies Act. So you'll see these references here, Section 30 or Regulation 28. So it's coming straight from legislation. And as I go through it, you'll see that there is also mention of non-profit companies, but I'm only going today going to focus on profit companies. So the first question that you need to ask yourself is your company a public company or a state-owned company? If it is a public company or a state-owned company, you have to be audited. You'll see here the company has to be audited. If you are not public and you are a privately held company, then there are further considerations. Here, if we look at a profit company, if you're a profit company and you hold assets in a fiduciary capacity for persons who are not related to the company, which exceeds 5 million rand at any time, then you have to be audited. If your PI score is 350 or more points, you have to be audited. And if your PI score is at least 100 points, and the annual financial statements were internally compiled, you also have to be audited. Now you might ask, okay, but what does internally compiled mean? Now, the financial statements from a Companies Act point of view are presumed to have been compiled internally unless they have been specifically independently compiled and reported by. And what does that mean? That means an independent accounting professional has actually compiled them. It's based on your financial records, but it is also in accordance to a relevant financial reporting standard. So in this case, you can see it mostly refers to compilation. If none of these requirements actually apply, then you go one step further and say, okay, well, the law doesn't require me to do an audit. What about my actual company documents? So if your company's memorandum of incorporation specifically states that you need to be audited, or you have voluntarily chosen to be audited, then your company has to be audited. If that is not the case, you then need to consider, okay, am I owner managed or not? So if all your shareholders are directors, then you are considered owner managed. However, if there is a shareholder who is not a director of the company, then your company has to be independently reviewed. If you are owner managed and you do that and you are less than 100 points on your PI score, and they are independently compiled, so you can see here that you don't meet these top requirements, but you are owner managed, then the company is exempt from both an audit and an independent review. If you look at the independent review side, if you have come through this matrix and you see, no, I do need to be independently reviewed, then you need to consider what your PI score is to determine who can conduct that independent review. So if your PI score is greater than 100, it is either a registered auditor or someone who is accredited with a professional body in terms a professional body who is recognized by the Accounting Professional Act, for example, CICA, so CA. Those are the two types of practitioners that can perform your independent review. If, however, your PI score is less than 100, it could either be a registered auditor, someone who is in good standing at a professional body that has been accredited in terms of the Auditing Professions Act, almost like a CA, or it is also someone who is qualified to be appointed as an accounting officer of the closed corporation. So you can see here from this decision matrix, it's a very good idea to get your accountant to guide you to choose the correct engagement, because there are quite a few considerations that you need to take into account. And it can get quite complicated in terms of your structure of your business, your PI score, and which category of engagement you fall into. Just remember also that this specifically, or as I go through these slides, I'm talking about companies. But if you are an owner or a member of a closed corporation, just remember that these sections do apply to closed corporations as well, because there are specific sections in the Companies Act and in the Closed Corporations Act that has scoped closed corporations into these engagements, or the requirements of the Companies Act in terms of these engagements, in terms of mandatory audits and things like that. The only thing that a CC or a closed corporation has not been scoped into is a mandatory independent review. However, nothing stops the members of a closed corporation voluntarily deciding that they want an independent review done, because it adds so much confidence and comfort on their financial statements to anyone who uses them, like financiers, banks, creditors, anyone like that. So always important, ask your accountant for guidance, especially when it deals with technicalities such as which engagement should apply. Then you could ask, okay, now I've chosen an engagement, or I've looked at the requirements in terms of which engagement is applicable, but when do I use which financial reporting framework? And once again, the Companies Act guides you in terms of legislation. So here your PI score comes into play quite a lot, because depending on your PI score, this will actually almost prescribe which financial reporting framework you need to use. So you'll see by going through each of these line items, if you have a PI score that is greater than 100, in these cases, you'll see these first three lines. So it's greater than or equal to 350, between 100 and 350 points, whether they are internally or independently compiled. Your frameworks that are applicable is either full IFRS or IFRS for SMEs. If your PI score is less than 100 and your financial statements are independently compiled, then you are also required to use full IFRS or IFRS for SMEs. But if you're a small business and your PI score is less than 100 and you actually prepare or compile your financial statements internally, then you can decide which financial reporting standard to use, as long as there's no prescription in legislation, and as also take into account what you are going to use your financial statements for. So if you're not expecting to get any finance from the bank or to use any creditors, then you don't necessarily have to use IFRS for SMEs. You can use tax-based accounting. Something important to remember is even though legislation prescribes in these cases that you can use IFRS or IFRS for SMEs, as a business or as a company, you are only allowed to use IFRS for SMEs if you fall within the scope of the IFRS for SMEs standard itself. So you need to go and look at not only the legislation, but the IFRS for SMEs scoping requirements too. And if you're a public entity listed on an exchange, then you would have to use full IFRS. You have no choice in that. Let's look at some practical considerations. In other words, what does a compilation and independent review and an audit actually mean? What not in terms of just theory, but what practicalities do I need to look at? What does my practitioner or my service provider actually do in terms of these compilations? These engagements. First of all, a compilation. Now you can see I've put a few keywords here. So compilation would usually start with engagement acceptance. And these acceptance procedures include the compiler coming in, chatting to management or directors, and getting a preliminary understanding of the client, of the business, assessing the integrity of management, the soundness of the financial controls in the business, and deciding whether they can actually take that engagement or not, also remembering that they need to take into account independence requirements. Once you've decided, okay, you can accept the engagement and you've documented all reasons why, the compiler will go on to obtain a further or more detailed knowledge and understanding of the business. The better understanding of your client, the easier it is to identify relationships between the figures in the accounts, to consider whether transactions have been accounted for correctly, and whether something is wrong or doesn't tie up. So it's very important to really understand what happened in that business during the year or the financial reporting period that you are preparing these financial statements on. The compiler will then prepare documentary evidence and adhere to the standard ISRS 4410, and this will include, for example, application or adherence to your financial reporting framework or IFRS for SMEs, making sure that accounting policies are appropriate. Has management made the correct estimates? How do the financials or the financial statements tie into the records of the company? What further communication had to be made with management? Investigations, judgments made? All of the work that is involved in compiling the financial statements then needs to be documented. If anything comes up as part of this compilation that could result in the financial statements being materially misstated or misleading, the compiler needs to propose amendments that will correct that and discuss that with management. And if management decides that they won't actually change or correct that, then the compiler needs to consider whether they withdraw from that engagement. If everything is fine, if they didn't find anything that could be a material misstatement or that was corrected subsequently, then the compiler will then conclude and finish with the compiling and reporting part of this engagement. In other words, they will prepare or draw or draft these financial statements, and they will also prepare a report of the compiler to say that they have compiled these financial statements, they have documented and adhere to the procedures of the specific standard, the ISRS 4410 standard, in terms of the engagement, and that will go into your financial statements as a sign-off report. Just remember that the compiler also needs to consider a materiality calculation as part of these beginning steps. Now, an independent review is a lot more detailed, and you'll see that there's a lot more work that goes into this independent review. Now, the independent review starts with planning procedures. Now, these pre-engagement activities are very similar to those performed for an audit, and there are certain mandatory procedures that need to be performed in terms of the engagement standard that is applicable to independent reviews. So that's ISRE 2400, International Standard on Review Engagements. And these include, for example, engagement acceptance, once again, planning in terms of what procedures need to be done, when are you going to be at the client, or you're going to do it off-site, things like that, just to make sure the engagement goes smoothly, and obtaining a preliminary knowledge of the business, setting up and signing terms of engagement with the client. Following on from that, the independent reviewer will obtain a detailed knowledge and understanding of the business. The independent reviewer must consider management's and staff integrity. They must chat to management and find out, how does the accounting system work? Do you have internal controls or financial reporting controls? Who deals with which transactions? How is the business run? Which customers and creditors do you have? A complete understanding of that business. They can use prior knowledge if this is a recurring independent review, because they need to place or kind of make an assessment as to what confidence can they place in the staff who prepares the accounts and compiles or prepares the financial statements, because that will directly flow into the next step, which is assessing the financial statement assertions and identifying risk areas. So in an independent review, it's the first time that we're now talking about risk identification. You'll see a compilation doesn't even look at risk at all, because it doesn't form any conclusion. An independent review requires that the reviewer assess the financial statement assertions. Now, what is a financial statement assertion? That is very much an auditing term. Now, assertions are the representations made by management regarding the appropriateness of various elements on the financial statements, disclosure line items. So I'd like to give you an example so that you can understand that. If you receive, let's say, I'm an accountant, and I'm about to perform an independent review for a client, and I receive their accounting records. By management handing me a complete set or a set of financial accounts or records, let's say a trial balance, management is implying that all the transactions that occurred during this period that we are reporting on are in those records. So the trial balance includes all the relevant transactions of the company. And that is what we would call the assertion of completeness. The financial statements are complete. The management would also be implying that the accounting records that they hand over to the independent reviewer are correct. And that would be mathematically, so to speak, that would be the assertion of accuracy. So there are various assertions that the independent reviewer needs to consider, and then they need to identify risk areas. In other words, depending on how the business is structured, who does the accounting, are there internal controls or not, is there possibly a risk area? Or am I happy as an independent reviewer that all the transactions are in the trial balance? In other words, completeness. And that is the link between the risks and the assertions. The independent reviewer will then take those risk areas and perform review procedures, mainly analytical procedures and inquiry, specifically on those risk areas. However, they will also perform procedures on overall reasonableness and using their professional judgment and skepticism. So it's focusing on risk areas or testing those areas, but also on an overall level as well. The independent reviewer will also consider things like events subsequent to the financial statement date, so what happened after year end, and if that has any impact on the financial statements at year end. Things like litigation that could come up. So you can see by getting this understanding of the business and chatting to management or through inquiry, the independent reviewer will then form an opinion on the financial statements. The reviewer will always consider compliance with the financial reporting standards, IFRS for SMEs or full IFRS. And they would use this testing or these procedures and then document that evidence. And once they are satisfied that they have gotten all the documentary evidence and all the testing that they need, the independent reviewer will then conclude and report on that engagement. When we talk about concluding and reporting, best case is if you get an unqualified or independent reviewer's report. That means that there was nothing that came to their attention that could lead to a material misstatement. Because you can just imagine the very reason that you're doing an independent review on your financial statements is to increase the comfort level and the confidence of, say, creditors or lenders in your financial statements. So you would want an unqualified opinion saying that nothing has come to attention, because if it was qualified or an adverse opinion, that would be raising warning flags. So it's important then that you have accurate accounting records, and also that the independent reviewer works with management if any misstatements are possibly noted. Something to consider is that an independent review is usually about a minimum of 50% of the work of a full-blown audit, but it could go up to almost 80–90% of what an audit entails, depending on the complexity of the business, the type of records, the transactions that occurred. So just keep in mind the time and the cost related to an independent review, depending on the complexity and the type of business. Let's have a look at an audit now. An audit at the top end of the scale is made up, or usually is formed, by 5 kind of distinct phases. Initially, the auditors will start with a planning phase. This includes the formal acceptance of the client, verifying independence requirements, because with an audit, independence is vitally important, building the audit team, and performing other procedures to determine the nature, timing, and extent of the procedures that they're going to use to conduct this audit. So the planning stage is quite extensive and also important because it forms the building blocks of the audit going forward. Moving on to risk assessment. So you'll see that an audit also entails risk assessment, the same as an independent review, because a conclusion or opinion will also be given on this engagement. The risk assessment involves, once again, obtaining knowledge of the business, the industry, and the environment in which that company operates, because the auditors need to identify and assess risks that could lead to material misstatement in the financial statement. So here, obtaining knowledge of the business is very important, as with an independent review, also a compilation. However, with an auditor or with an audit, you need to go even a little bit further. You need to consider the industry in which that company operates. You need to consider judgment and experience and knowledge. So to make sure that you identify risk, not just in the financial statements, but potential risk that could affect those financial statements from outside factors. So it's a good understanding that you need of the business and risks, and that is why it takes so much more time to perform these procedures. Once you've identified the risk as an auditor, you will go on to develop the audit strategy and plan. The overall audit strategy and detailed audit plan is then set up to address these risks that have been identified. So you are designing a testing approach, deciding which internal controls are you going to test and could you possibly place reliance on them, and then what extra substantive procedures you will then do. So just to look at the difference between tests of controls and substantive procedures, tests of controls are looking at the systems in place in the company and how those work to make sure that your financial records are accurate, complete, and correct. If the auditors are satisfied that the controls work correctly and that they have worked over the period of that financial reporting, financial statements, it would actually reduce the amount of substantive or detailed testing that you need to do. Because if your controls are working properly, it reduces risk. Substantive procedures include things like third-party confirmations, tracing samples of invoices back to transactions, things like that. And that is all determined through the audit plan. They will also then allocate tasks to audit team members. And this strategy and plan is also very flexible. It changes during the audit, depending on what information comes up or things that might have changed as they get more information on the client. So based on this audit strategy and plan, the auditors will then gather evidence. So they will apply professional skepticism and judgment when gathering and evaluating evidence through testing of the company's books and the information. So you can see that is where most of the kind of nitty-gritty ticking and bashing work happens, in that phase. And once that work has been done, the auditors then move on to the finalization phase. So there they exercise professional judgment and form an overall conclusion based on the results of their testing, the evidence that they obtained, the work that they have done, and this conclusion forms the basis of the audit opinion. In other words, do the financial statements present fairly in all material respects, the financial position and financial performance of the company, or through that testing, can they conclude that no, wait a minute, these financial statements don't fairly present in all material respects the financial position of the company, and that would be a qualified opinion or an adverse opinion, which is naturally something you would want to avoid. Just remember also with an audit, because a lot of business owners think, okay, well, my financial statements have been audited, so everything must be 100%. That's not necessarily the case. Due to the inherent limitations of an audit, you might have certain cases where material misstatements or fraud was not detected, just because of the nature of an audit. So it's important to remember that you don't get absolute assurance. And interestingly enough, which some business owners might also think, is that an audit doesn't provide assurance that service delivery has been achieved. So it's got nothing to do with the business side of the company, but it's got everything to do with the reporting side of the company. So where does your accountant fall in these engagements from a reporting point of view? What role does your accountant play? Now, it depends very much on the structure of your business. And I've listed a few things here that your accountant can assist with, but this is by no means an exhaustive list. It's really just touching the tip of the iceberg, because it really depends on how you've structured your business. So say, for example, you might have an in-house accountant. So they could be responsible for maintaining accurate and complete accounting records, ensuring compliance not only with accounting standards, but also with your legislation and tax. You could have an outsourced accountant, so someone who is a little bit more independent. So they might be doing accounting services for you, but because they're independent, they might be able to perform a compilation engagement as well. So you can see, depending on how you structure it, what role your accountant could play. But throughout, your accountants are normally required to exercise integrity and ethical practices. They must act with professional competence and have the necessary technical skills. And if we look at the different engagements, say, for example, compilation, as I mentioned, you might have an external accountant who can then perform that compilation for you. Or if you have an in-house accountant and someone else compiles your financial statements, they could then assist with providing information to the compiler. With an internal review, because there is that independence requirement, you won't normally find your in-house accountant preparing an independent review for you. It has to be an outside professional. So there, your accountant would then assist the independent reviewer with information that they might need, queries that they might have, amendments that might be recommended, anything like that. And when it comes to an audit, once again, the main role of the accountant is to prepare and provide information that are required by the auditors. They might draft the financial statements. So it's a process of providing assistance to make the whole audit as seamless as possible. Now, what's really quite nice is that Dan is in a very unique position to provide accounting services, compilation engagements, as well as independent review engagements, because each BAN franchisee is independent from one another, as well as being independent from BAN itself, because we are all business owners in our own right. So that means you might have one BAN franchisee who does your monthly accounting work and prepares your financial statements in terms of a compilation engagement, and another BAN franchisee or colleague almost could then perform your independent review, because they are completely independent from the books or the records of that client. So as you can see, it is very important to team up with the right professionals to make sure that you get the correct guidance and the correct technical standards with regards to your reporting requirements. We'd like to invite you to our next client webinar, which is being held on the 29th of August in our usual time slot of an hour between 9 and 10 o'clock. And the topic is the Dirty Dozen, the most dangerous agreements on earth. This will be presented by Robin Hay from Robin Hay Attorneys, who is a wonderful presenter, and it promises to be very informative. As a business owner myself, I'm very keen to attend. And that concludes our webinar for today. If there are any questions, please feel free to send them through on the webinar platform. Shane, if there are any questions, please collate them and we'll see if we can get some more information out to our attendees.
Requested us to go through the slide of the PIS score again. I think that it will probably be better that they go onto our website once we've loaded the webinar under the events page and have a look at the webinar again, and they can go through the PIS score. I've also referred the person to the actual section of the Companies Act that they can also have a look at to get that answer.